It's about a relationship between gold and the 10-year Treasury yield stretching from the 70 all the way to today. Gold. And once you understand this relationship, a lot of things that feels confusing right now start to make sense. This chart. So you see two lines over time. One is your horizontal axis. You have years starting from 1970 and running through the mid 2020s, and times moves from left to right. You see the price of gold shown by gold colored line and shaded area. This is prices at the average. This is the average price, okay, of US dollar. That's why it never reaches 5,000. It's average annual price. So in simple term, the red line is the cost of money, and the gold line is the store value. The first thing that surprised most people is that in the 70s, gold and yield rose together. Gold starts low and moves sharply higher, and at the same time, the 10-year yield explodes upward. Most people thought at that time, well, if rates go up, gold must go down. Isn't this supposed to inverse relationship? What happened in the 70s wasn't just about rates, it was about the loss of confidence, if you remember. Inflation was rising and money was losing purchasing power. People demanded high yields to lend money. But they also rushed into gold because cash was melting, bonds were unstable, trust in the system was fading, so yields went up because investors demanded protection, and gold went up because investors wanted safety. They weren't opposites, they were responses to the same problem. So now move your eyes towards the middle of the chart. The red line trends downward. Gold stays mostly flat and unexciting. This is the area of falling inflation, rising productivity, strong belief in central banks, stable growth. When people trust the system, gold loses urgency. During this period, bonds felt safe, cash held value, and growth assets worked. Gold didn't collapse, but it didn't lead either. And gold doesn't need growth, it just needs doubt. So in 2000, you have a critical shift. And now watch closely as we move in the early 2000s. Yields continue falling, but something changes. Gold starts to rise. This is important because for the first time in decade, yields are falling. And gold is rising. This tells us something powerful. It tells us that people weren't buying gold because rates were low. They were buying gold because risk was rising. Remember, it's all about risk. You may not understand it. You may not want to know it, but it's what drives this whole game. Debt was growing. Financial leverage was increasing. The system was becoming more fragile. 2000. Gold was no longer reacting to inflation. It was reacting to stress. The red yield line collapses towards historic lows. And gold surges sharply higher. Why? Because after 2008, central banks start printing money. Interest rates were pushed down to almost zero. Debt exploded. Yields were low, not because things were healthy, but because things were fragile. Gold rose because investors no longer trusted paper promises. Financial stability felt artificial. Risk was being hidden, not removed. Low yields didn't mean safety. It means intervention. And gold responded accordingly, meaning I don't believe what I'm seeing. Now, 2000 to 2022, as you could see towards the right of the chart, once again, something interesting happens. Yields rise sharply. Gold also rises. This confuses people. But by now, you should recognize the pattern. When yields rise because growth is strong, gold struggles. But when yields rise because inflation and debt risk are high, gold survives and often thrives. This is not really about a direction. This is about why. So what does this 50-year relationship really say? It says that gold doesn't compete with yields. It competes with confidence. When people trust money, gold sleeps. When people fear money, gold wakes up. And high yields can happen in healthy systems or stress systems. Gold rises when yields reflect stress, not strength. That's a difference most people miss. So, okay, great. So what does this mean going forward? We are in a period, regardless of what you've seen gold done lately, debt is high, confidence is fragile, policy tools are stretched, volatility is structural, not temporary. This does not mean gold must go straight up. It doesn't mean yields must fall. It means the old assumptions no longer apply cleanly. So gold and yields can rise together, and gold and yields can fall together. What matters is the trust. I'm not telling you what to buy. I'm telling you how to think. Right? Because in markets, thinking correctly matters far more than predicting.